Have you ever watched the crypto market and felt like you were on a brutal roller coaster where prices launch to the moon one day and then just absolutely crater the next? It can feel totally chaotic, especially when you hear about billionaire whales making billion-dollar moves, or a single government tweet wiping out fortunes. But what if you could actually make sense of it all? That whiplash is enough to leave even the most experienced investors feeling lost and powerless. You see that big green candle in the FOMO, the fear of missing out, starts talking. Then, boom, a sea of red floods your screen, and that panic sell instinct kicks in hard. That's just life in the crypto market, where it feels like your financial future is decided in the blink of an eye. And if you don't understand these forces, you end up making emotional decisions, buying at the very top and selling at the absolute bottom. Basically, gambling, not investing. What if you could understand the method behind all this madness? What if you could see who's really pulling the strings? We're about to break down the biggest factors behind crypto's insane volatility. And then, I'll show you how to use that knowledge to not just protect your portfolio, but to actually find opportunities in the chaos. To survive the crypto storm, you have to know what causes it. This isn't just random luck, there are real, identifiable forces at work. Let's dig into the 5 biggest drivers of crypto's volatility. Number 1, the scarcity and hype machine. At its heart, crypto is driven by basic supply and demand, but with a wild twist. Many major cryptocurrencies, most famously Bitcoin, have a fixed or predictable supply. Bitcoin is hard-capped at 21 million coins, period. This built-in scarcity is why you hear people call it digital gold. So when demand suddenly explodes thanks to big news, a company adding it to their balance sheet, or just a wave of public excitement, the price has nowhere to go but up. The supply can't just ramp up to meet the new demand. But that's a double-edged sword. If that demand vanishes or flips negative, the price can crash just as violently. Because the asset is still so new, there isn't a long, stable history of demand to keep its value anchored, leading to these massive, gut-wrenching swings. Number 2, the whales in the crypto ocean. In the crypto sea, some fish are a lot bigger than others. Whales are people or groups holding gigantic amounts of a specific cryptocurrency. Because many crypto markets, especially for smaller altcoins, have fairly low trading volume, these whales can create huge waves with a single move. Unlike the stock market, where a billion-dollar trade might barely make a ripple, a similar-sized sell-off in crypto can spark a market-wide panic. These massive holders can sometimes manipulate prices on purpose, or just cause chaos by rebalancing their own portfolios. When a whale moves a huge chunk of crypto onto an exchange, traders see it as a sign they're about to sell, causing smaller investors to rush for the exits first. It becomes a self-fulfilling prophecy, and the price tanks. For many traders, tracking these whale wallets has become a full-time job. Number 3. The power of news, hype, and FUD. The crypto market is powered by pure sentiment, and its fuel is information, and a lot of misinformation. News, rumors, and hot takes on social media platforms like X and Reddit can spread like wildfire, causing prices to move based on nothing but pure emotion. This usually gets boiled down to 2 famous acronyms: FOMO, the fear of missing out, which causes those insane parabolic price spikes as everyone scrambles to buy. And then there's FUD, which is fear, uncertainty, and doubt. A single tweet from a big-name influencer, a negative headline, or a rumor about a project being a scam can trigger a tidal wave of panic selling. This creates a nasty feedback loop. Falling prices lead to more FUD, and more FUD makes prices fall even faster. This cycle is one of the main reasons we see that short-term whiplash-inducing volatility almost every day. Number 4, the long shadow of regulation. Crypto still exists in a bit of a legal gray area, and that uncertainty is a huge source of volatility. Markets hang on every word from government bodies like the SEC in the US or other global regulators. An announcement about a possible crackdown, a ban on crypto mining in a major country, or a lawsuit against a big exchange can send the entire market into a freefall. On the flip side, good news, like the approval of a Bitcoin ETF or a government officially calling a crypto asset a commodity instead of a security, can ignite monster bull runs. These regulatory moments act like shockwaves, changing the entire market's perception of risk and legitimacy overnight and causing huge, instant price swings. Number 5, leverage and the domino effect. Finally, one of the most violent drivers of crypto volatility is the widespread use of leverage. Traders can borrow money to place bets that are way bigger than their actual capital. While this can supercharge your gains, it also multiplies your losses. When the market moves hard against a highly leveraged trader, they get a margin call, which forces them to either deposit more money or have their position automatically sold by the exchange. This forced selling is called a liquidation. During a sharp price drop, thousands of these liquidations can get triggered all at once, creating a devastating domino effect known as a liquidation cascade. Each wave of forced selling pushes the price down even further, which then triggers the next wave of liquidations. This is exactly how a small dip can turn into a full-blown market crash in just a few hours. So, you've got the limited supply, the massive whales, the social media storms, the threat of regulation, and the liquidation dominoes. If this is starting to connect the dots for you and you're finding it valuable, do me a huge favor and smash that like button and subscribe to the channel. It really helps us make more content like this to help you on your crypto journey. Okay, so now you know the rules of the game, but how do you actually play it without getting totally wrecked? Understanding the market is so crazy is only half the battle. Now let's get into the actual strategies you can use to manage this chaos and turn all this volatility from a threat into a real opportunity. Strategy 1. Build your fortress with risk management. Before you even dream about profits, you have to survive. This is the #1 rule, and it's non-negotiable. Only invest what you are genuinely prepared to lose. Your entire strategy needs to be built on a foundation of solid risk management. First, instead of trying to perfectly time the market, use dollar cost averaging, DCA. This just means investing a fixed amount of money on a regular schedule, like $100 every Friday, no matter what the price is doing. When the price is high, your $100 buys less. When the price is low, it buys more. Over time, this smooths out your average cost and helps you weather the volatility. Second, learn to use stop losses. A stop loss is an automatic order you set to sell your crypto if it falls to a certain price. Think of it as your emergency exit. It pulls the emotion out of the equation and stops a small loss from becoming a devastating one. And finally, be extremely careful with leverage. For almost everyone, especially if you're just starting out, the best move is to avoid it completely. Using too much leverage is the fastest way to get wiped out. Strategy 2. The defensive play to protect your capital. Once your fortress is built, you can start thinking about defense. In the regular world of finance, investors buy insurance. In crypto, one way to do that is with derivatives, like options. Now this can get complicated, but let's talk about a simple concept: the protective put. Buying a put option gives you the right, but not the obligation, to sell an asset at a set price. Think of it as an insurance policy for your crypto. If you own 1 Bitcoin and you're worried about a crash, you could buy a put option that lets you sell it at a price near what it's currently worth. If the price does crash, the money you make from your put option helps offset the losses on the Bitcoin you're holding. If the price goes up instead, you just lose the small amount you paid for the option premium. This is a hedging strategy used to protect your portfolio from big drops, and it's a seriously powerful tool for handling volatility. Strategy 3. The offensive play to find opportunities. Volatility isn't just a risk. For those who are ready, it's a huge opportunity. Active traders use strategies designed to thrive in chaotic markets, but a word of warning: these require experience and a ton of discipline. One common approach is trend following. After a big event, like some positive regulatory news, a strong trend can form. A trend-following strategy is all about identifying that new direction and riding the wave, using strict rules for when to get in and when to get out, often with a trailing stop-loss that moves up with the price to lock in profits. Another strategy is mean reversion. This is built on the idea that huge price moves are often just emotional overreactions. Traders using this strategy will look for assets that have been crushed by FUD and bet on them reverting or bouncing back toward their average price. These strategies are not for the faint of heart and demand a real understanding of how markets work, but they show how volatility itself can become a profitable tool. Strategy 4. Master your own psychology. This might be the most important strategy of them all. In a volatile market, the biggest risk isn't the coin you bought, it's you. Your own emotions are the easiest thing for the market to exploit. You absolutely have to develop a long-term mindset. Zoom out the charts. You'll see that despite the insane short-term noise, major assets like Bitcoin have trended upwards over the long run. The day-to-day volatility is often just that, Noise. Make a plan and stick to it. Define your goals, your entry points, and your exit points before you put a single dollar in. Write it down. This is what will stop you from making an impulsive trade because of a bright green candle or a scary news headline. Unfollow the social media gurus who only post rocket emojis, and find sources that give you real data and analysis. Turn down the noise and trust your plan. So let's put it all together. The wild, unpredictable crypto roller coaster is driven by a few powerful forces: a fixed supply clashing with wild swings in demand, the outsized influence of market whales, the emotional storms brewed by news and FUD, the constant shadow of regulation, and the devastating liquidation cascades from too much leverage. But chaos doesn't have to mean you're powerless. By understanding these drivers, you can start seeing the patterns behind the price action. And, by using a smart strategy, building a fortress with risk management like DCA and stop losses, playing defense to protect your capital, and, most importantly, mastering your own emotions, you can navigate this market with confidence. Volatility is a double-edged sword, but with the right knowledge and a disciplined plan, you can avoid its sharpest edge and put yourself in a position to take advantage of the opportunities it creates. Invest smart, stay disciplined, and don't let fear or greed be your guide. If you want to go even deeper on crypto strategies and market analysis, make sure you subscribe and hit that notification bell so you don't miss what's next. And check out the playlist on your screen for more guides just like this one. Thanks for watching, and I'll see you in the next one.